Welcome to Stock Talk with Mike. I'm back with another Jumia video. I just feel like the message boards and investors in general are so polarized on Jumia that definitely it's caused me to continue to dig a little deeper. And I just have some additional thoughts on Jumia and I want to talk a little bit about some of the risk and how I think you should position yourself as well. But what I think the upside is, I even got a price target for Jumia that I've added in this video for the next 5 years. And then also I want to do a little bit of a comparison of Jumia to the e-commerce leader in Latin America, that's MercadoLibre, and also the early days of C Limited, the e-commerce and digital entertainment leader based out of Singapore serving Southeast Asia. So if you like this kind of content, please consider subscribing to the channel and liking this video. I think it's important we have a little bit of perspective with Jumia. And keep in mind, this is a company that's only been around, or it was only founded in 2012, right? And just went public a year and a half or so ago, maybe 2 years ago now, and is extremely small for an e-commerce leader. We're talking about a company that still has under $200 million in revenue annually and a market cap of around $5 billion. So I think that's important. Obviously, Jumia has a lot of risks in front of it. They need to figure out logistics, for example, and they've made some good strides in that with Jumia Logistics. And they need to get their expenses under control. And I think they made some good headways into doing that by cutting out a lot of very large first-party items they were selling and focusing more on third-party selling. So those two moves alone, I think, are massive for Jumia. But I think it's important that we know that these risks are there, but that's why there's so much potential upside still for the company. It is still in its early days. Yeah, I think it's fine if you're the type of investor that wants to see how this, wait and see how this plays out, and to see if they get the logistics sorted out, to see if revenues from third-party selling start to skyrocket and margins start to really improve. It's fine to wait till those things happen, but it'll be trading at a much, much higher valuation than it is today. So I think that's something to keep in mind. When you think of other national e-commerce leaders in countries that honestly have faced some of the same similar challenges, like MercadoLibre and C Limited, we're talking about companies with market caps that are 20 times that of Jumia. Granted, they also have 20 times the revenue, but that just kind of speaks to the kind of opportunity we can have here. So in Africa, in 5 years from now, they're expecting e-commerce to be a $50 billion industry. And we're thinking of Jumia with revenues currently of around 200 million. There's a lot of potential runway there, and they are the front-running leader for e-commerce in Africa. So that alone, I think, is really good sign for them. And I think, honestly, you know, they've been on a big run. So I think a lot of it is just you're going to get the haters that come out, or people that just been on the sidelines or maybe don't really understand the company that are going to sort of knock it. And honestly, I wouldn't be totally surprised, like after this massive run, just looking at the chart here, if we see some volatility and somewhat of a sell-off at some point, especially if we have a market downturn. Obviously, companies that go on the biggest run tend to fall the hardest. So I could see Jumia being hit in something like that. But that doesn't mean anything's changed about the underlying business if the market sentiment changes like that. So personally, I'm viewing Jumia I am generally a long-term investor, and some of my speculative plays are more for the short term, but I would call Jumia in the speculative camp still, because there is a lot of unknowns with Jumia, but it's sort of more of a long-term speculative play. And unless something fundamentally changes where I don't think they're going to be able to right the ship or start to substantially grow the top line revenue number, I plan to hold for the long term, and that definitely means bare minimum sort of 5 years. I'll trade around that position, but I plan to hold a core position. And just looking at C Limited, so I mentioned that they're obviously a $5 billion company, Jumia. C Limited, out of Singapore, so an e-commerce leader in Southeast Asia. And so their e-commerce portion of their business is now getting close to half. It's accelerating incredibly quickly, growing like 100% year over year. But they more started on the digital entertainment sides with their platform that has PC and mobile games. So their e-commerce platform is called Shopee, and it's really big in Southeast Asia. And they also have Shopee Pay, so digital wallets, similar to Jumia's Jumia Pay. But their market cap, we're talking about a $112 billion company that has about $3.5 billion in revenue annually. So about 20 times the sales and about 20 times the market cap as well. And this is a company that's grown incredibly fast as far as share price appreciation. When they came public in 2017, share price about $15. We're now talking about a $219 stock. So just a massive run up, and it did trade sideways for quite a long period as well. So obviously we've really seen those revenues as they grow in their e-commerce just start to accelerate like crazy, and I'm looking forward to seeing that with Jumia as well. And we compare it to MercadoLibre too. So MercadoLibre in Latin America, they're a big e-commerce leader there. They also have Mercado Pago, which is their digital wallet as well. And they're a company that was founded in 1999. So you compare it to Jumia 2012. Of course, they've reinvented themselves a little bit since then, but they've been around a really long time. Same with C Limited. They've been around a handful of years longer than Jumia as well. Just didn't come public till more recently. But MercadoLibre has actually been public since 2007 and struggled for quite some time. So it was about, what was it here? It was $42 a share back in 2007 and traded fairly sideways. Was still in the single hundreds in 2016 before shooting up to where it is today, like to over $1,800. So just massive runs in both these e-commerce plays. And again, a market cap 92 billion. So and revenues around 3.4 billion annually. So about 20 times the size that of Jumia. So of course you are expecting better things out of a company that's being valued at 20 times that of what Jumia is. I feel like people have no problem right now. The sentiment is that there's really no issue with throwing money at highly speculative companies that are basically pre-revenue with an idea of how they may be revenue generating. And the thing is, once you're revenue generating company, you still have to figure out how to become profitable and run a successful, sustainable business. And Jumia is in that inflection point right now, and they're making some changes to their business that is largely going just, I think, really misunderstood. All right, so Jumia, I'm really looking forward to seeing their Q4, but we're still looking at Q3 numbers, and I've put this up before, so I just want to point out something else about this Q3. So I've talked about how they saw a decrease in revenue overall last quarter of 12%, or sorry, 18% in the quarter and 12% for the 9 months. Decline in revenue that people scoffed at. But part of, like a large part was that they had on the quarter, they had a 53% decrease in first party revenue, which, and again, I talked about how that was a planned approach as they focused on better margin business of third-party selling. But the interesting piece here, I think, read this bottom part in red here. Shifts in the mix between first-party and marketplace activities trigger substantial variations in our revenue as we record the full sales price net of returns as first-party revenue and only commissions and fees in the case of marketplace revenue. So think about that, right? So if they're selling a product, say they're selling you a vacuum cleaner, and they manufacture that vacuum cleaner and sell it to you. That revenue, say it costs $100. The revenue they record is $100. But if another business is going to sell their product through Jumia, sell their vacuum for $100, they just record the commission they get on it. So whatever it is, $10. Obviously, the commissions are going to have way better margins and are going to show up as a much smaller budget or on the revenue line is a much smaller amount because they're just recorded the commission piece and the fulfillment piece. So this commission and fulfillment line here up here in green, those are revenue from the sale of the product, not the total price of the product, if that makes any sense. So I guess a good way of thinking of that is like a real estate agent, their commission revenue versus an iBuyer program or a house flipping operation like Open Door. When they sell a home, they record the whole value of the house as revenue, even though obviously most of that is going to be expensed. So really, it's kind of comparing apples and oranges here, where they're growing their commission business, which is obviously going to be much smaller increments than when they were recording all this first-party revenue. But it gets all convoluted by analysts and everyone else, like, oh no, revenues are declining. But we actually look, commissions on the quarter were up 43%, and on the 9 months, 49%. So just seeing massive growth in the area of the area of their business they were focusing on. And that number appears smaller than in a way it really is. If you looked at the gross merchandise value of those sales, is actually much higher. So I think what's going to happen though, so this first party revenue, that's a poor margin business that they're getting away from. I think what's going to happen now is obviously is next year. So I think next quarter we might still see that big decline in that number. By next year, that'll be off a much smaller base. So I don't think you'll see those drastic declines. I think analysts are expecting over 30% revenue growth for 2021 as a year in whole. So that'll be interesting to see. But what they want you to focus on, what Jumia wants you to focus on, is the gross profit and the operating loss lines. And they actually increased gross profit on the 9 months by 27%. So, I mean, revenue is heading in the right direction. It's really semantics that people are really focusing on. And I mean, the operating loss is an issue. They're operating at a massive loss still, but they actually on the quarter, they decreased their losses by almost 50%. So that's really good news that they're heading in the right direction. All right, so here's my pricing outlook for Jumia over the next 5 years. I made obviously some big assumptions here. I've used a revenue growth rate of 40%, as I do think as first party sales become a smaller portion of their business, it'll become less relevant as they grow the third party sales, which is growing at well over a 40% clip now. I think a 40% clip over 5 years is completely reasonable. And then on the expense side of things, I've included a slight reduction in the cost of sales. So right now, expenses, cost of sales is about 50% right now of their revenue. And I've lowered that to 40% by 5 years from now. Last quarter, they actually decreased their cost of sales by about 20%. So they are actually decreasing that as well. And advertising and marketing, I dropped from 22% to 10% as they are aggressively reducing those costs and finding efficiencies there as well. They dropped 55% last quarter. And I upped tech and development from 35 to up to 50 million. And general and admin, I increased from 167 up to 200 million. Obviously that didn't grow proportionally with their revenue, that expense, but I think they'll be able to scale their business and their general administration better as their business continues to grow. So I plugged in a PE of 75. It's really hard to say where a company like this would be priced, but with a trailing PE of 75, I think that would be reasonable given it has a 40%, I'm estimating a 40% growth rate at that time. And using that number, and based on how expensive e-commerce players that are growing tend to trade at, a lot of them aren't even profitable, right? As they focus more on growth. So it really depends on their growth rate. But using that PE of 75, that would give us a share price of $174 a share in 2026, which would be another 208% return with an average annual return of 25%. So I think that's actually completely reasonable. Again, these are total estimates. I mean, there is a risk here with Jumia, and I think it's a company that you do need to watch. Jumia is a funny one for me because it started as quite a small position, and I trimmed it as it grew last year. but it just kept growing, and I had to keep forcing it down to keep it a reasonable size in my portfolio. And it's still probably a top 5 holding for me now, but it just with the run it's had, I'm comfortable with its current position size in my portfolio. Anyways, that's about all I have on Jumia today. As I mentioned, these other e-commerce players, and I recently did a video on Amazon too, and I talked about the opportunities for their massive growth in the India market. But I'm very interested in all these big e-commerce players. I think there's still a lot of room for all of them. I own shares of Amazon. I own shares of Alibaba actually as well, as I think more of the value side. Amazon I still think has good growth and is a safer bet. Jumia is more of a speculative play. And then I also own C Limited as a massive large growth play as well. And I wish I owned shares of MercadoLibre years ago, but I don't own any shares of MercadoLibre. So anyways, but that's about all I got for you today. I hope to do a video on C Limited in the near future as well. It's another company I own and I think has a lot of continued runway ahead of it. But that's all I got for today. Thanks a lot for watching.